A woman in Calgary, Alberta, has had the same checking account at the same bank for 19 years. She has never missed a payment on anything. She has never been in overdraft. She has her paycheck deposited directly, her mortgage payment automated, her credit card linked. She is, by every measure, exactly the kind of customer a bank wants. Last March, she sat down with her last 12 months of bank statements for the first time in years. Not because anything felt wrong, but because her accountant asked her to. She went line by line. It took her 40 minutes. She found $438 in fees she had never consciously authorized, never knowingly agreed to, and in 3 cases could not find any explanation for whatsoever. Monthly account fees. Interac e-transfer fees on her own money. An inactivity fee on a savings account she did not know was still open. A paper statement fee she had been paying for 11 years despite going paperless in 2013. An overdraft protection fee on a service she has never used and never will. She called the bank. She was transferred twice, placed on hold for 22 minutes, and ultimately issued a partial goodwill credit of $60, $378. Gone. For the privilege of storing her own money in an institution that lends it out at 8% and hands her back 0.01. She is not unusual. She is the median Canadian bank customer, and the $438 she lost last year is almost exactly in line with what independent financial researchers estimate the average Canadian pays in bank fees annually. Most of it invisible, most of it avoidable, and all of it legal under-account agreements that run to 40 pages of fine print that nobody reads. That is not an accident. That is the product. To understand how we arrived at a system where the average Canadian pays hundreds of dollars a year to access their own money, you need to understand what the retail banking relationship was originally structured to deliver. For most of the 20th century, Canadian retail banking was a straightforward exchange. You deposited money. The bank held it safely, lent a portion of it out at interest, and used the spread between what it paid depositors and what it charged borrowers to cover operating costs and generate profit. Checking accounts had modest fees. Savings accounts paid meaningful interest. The relationship was simple enough that most Canadians understood it intuitively. The Big Six, Royal Bank, TD, Scotiabank, BMO, CIBC, and National Bank, operated under a regulatory framework that limited competition but also limited predatory fee structures. Branch banking was expensive to operate. Tellers were paid to process transactions. The cost of delivering service was visible, and the fee structure reflected it imperfectly, but honestly. Then 3 things happened simultaneously, and they transformed the fee architecture completely. Digital banking eliminated the cost of transactions. By the mid-2000s, the marginal cost of processing an online transfer, a bill payment, or an account balance inquiry had dropped to near zero. The infrastructure investment was made. The variable cost per transaction was negligible. The banks did not pass those savings to customers. They kept the transaction fee structure, in some cases increased it, while their cost to deliver the service collapsed. The spread between what a transaction costs a bank to process and what a bank charges a customer to process, it widened dramatically through the 2010s. Account complexity exploded. The Big Six expanded their account product lines from a handful of simple account types to dozens of tiered accounts, each with different monthly fees, different transaction allowances, different overdraft structures, and different minimum balance requirements. The complexity is not accidental. A simple, transparent fee structure is easy for a customer to evaluate and optimize. A complex structure with multiple fee categories, conditional fee waivers, and tiered service levels is difficult to monitor, easy to drift out of optimal positioning on, and generates significantly more revenue from inattentive customers. And the fee categories multiplied. Monthly account fees, per transaction fees above monthly limits, Interac e-transfer fees, not sufficient funds fees, overdraft fees, overdraft protection monthly fees, paper statement fees, inactive account fees, safe deposit box fees, wire transfer fees, foreign transaction fees, stop payment fees, certified check fees. The list is not a list of services customers requested. It is an inventory of revenue streams the bank engineered into the account structure and then normalized through repetition until they became invisible. The result is a Canadian retail banking system that is among the most profitable per customer in the developed world. Not because Canadian banks are exceptional lenders or exceptional investors, but because they are exceptional fee collectors operating in a market with limited competition. Let's start with the most straightforward fee in the Canadian banking system, the one that appears every single month. Regardless of what you do with your account, because it is the fee most Canadians could eliminate entirely and have not. The major Canadian banks charge monthly account fees ranging from $4 to $30.95, depending on the account type. The most common account tier typically carries a monthly fee between $10.95 and $16.95. At $15 per month, you are paying $180 per year, before a single transaction fee, before a single service charge, before anything else on your statement. $180 annually for account existence. Now here is the provision your bank mentions only in small print and never proactively explains. Every major Canadian bank waives the monthly checking account fee when your account maintains a minimum daily balance. The balance threshold varies by bank and account type, typically between $2,000 and $4,000. If your account balance never drops below that threshold at any point during the month, the monthly fee is waived entirely. If you routinely carry $3,000 or more in your checking account, and many Canadians do, either by habit or because their paycheck deposits leave a consistent buffer, you may have been paying a monthly fee for years that you were entitled to have waived. The bank knows your balance. The bank can see that you qualify for the waiver. The bank does not apply it automatically. You have to know to ask or to structure your account to trigger it. Call your bank today. Ask what the minimum balance requirement is. Then look at your last 6 months of statements and determine whether your balance has consistently exceeded that threshold. If it has, request a refund of fees. Banks will not always agree to the full retroactive refund, but many will issue partial credits. And going forward, you can eliminate the monthly fee permanently. If your balance does not consistently meet the threshold, there is a second option. Several of Canada's credit unions and online banks offer genuinely free checking accounts with no monthly fee, no minimum balance requirement, and no transaction limits. Simply iFinancial, the online banking arm of CIBC, offers a free checking account. Tangerine, owned by Scotiabank, offers a no-fee checking account. Bank offers a savings account that functions as a checking account with no monthly fees and a meaningful interest rate. These are not obscure institutions. They are backed by major banks and covered by CDIC deposit insurance. The only meaningful difference between them and your current account is that they are not charging you $180 a year to exist. The monthly account fee is the most visible line on your statement. The transaction fee architecture is the less visible one, and in many cases it generates more revenue. Standard checking accounts at the Big Six include a fixed number of monthly transactions, typically 12 to 25. After which each additional transaction carries a fee of 65 cents to $1.50. The definition of transaction is broader than most customers assume. It includes debit card purchases, bill payments, pre-authorized debits, checks written, and in some account types, even Interac e-transfers. The average Canadian household conducts well over 25 banking transactions per month. Grocery runs, gas station stops, online bill payments, subscriptions on pre-authorized debit, e-transfers to split restaurant bills or pay rent. The transaction count accumulates faster than most people track. On a standard 12-transaction account with a $1 per transaction overage fee, a household conducting 40 transactions per month is paying an additional $28 per month in transaction fees on top of their monthly account fee. That is $336 per year in transaction overage charges alone. On an account they are already paying $180 per year to hold. The solution is straightforward but requires knowledge your bank will not proactively share. Unlimited transaction accounts exist at every major bank, and the price difference between a limited transaction account and an unlimited transaction account is often smaller than the transaction overage charges a heavy user accumulates. At RBC, the difference between the day-to-day banking account at $10.95 per month and the signature no-limit banking account at $16.95 per month is $6 per month, $72 per year. If you are paying $28 per month in overage fees on a limited account, switching to unlimited saves you $22 per month, $264 per year. net of the higher monthly fee. Count your transactions. Look at the last 3 months of your statement and count every single debit transaction, bill payment, and e-transfer. If you are consistently exceeding your monthly limit, you are paying more to stay on your current account than you would on an unlimited account. The bank knows this. The bank has not told you. This one has become less universal in recent years. Several account types now include unlimited Interac e-transfers, but it remains a significant fee category for a large number of Canadian bank customers, and it is worth examining specifically because of how transparently absurd it is. Interac e-transfers are a Canadian interbank payment system that allows real-time money movement between Canadian bank accounts. The marginal cost to a bank of processing an Interac e-transfer is negligible. The infrastructure exists. The transaction is automated. No human being touches it. Several major bank account tiers still charge between $1 and $1.50 per outgoing Interac e-transfer. For a customer who uses e-transfers regularly, to pay rent, split bills, pay a contractor, send money to family, this fee accumulates quickly. 10 e-transfers per month at $1 each is $120 per year. For moving your own money between Canadian accounts, the e-transfer fee is one of the clearest examples of a fee that exists not because the bank incurs a cost worth recovering, but because it can be charged and most customers will absorb it without calculating the annual total. If your account charges for e-transfers, either upgrade to an account tier that includes unlimited e-transfers and verify that the fee saving exceeds the account upgrade cost, or move your banking. Overdraft fees represent one of the most profitable and most criticized fee categories in Canadian retail banking, and the architecture around them is specifically designed to maximize fee generation while appearing to offer a customer protection. When your account goes below zero, when you spend more than your balance, there are 2 possible outcomes. If you have no overdraft product, the transaction is declined and the bank charges you a non-sufficient funds fee, typically $45 to $48 per occurrence at the Big Six. If you have overdraft protection, the transaction goes through and you are charged an overdraft fee instead, plus potentially a monthly overdraft protection fee, just for having the service available. Let me walk through the full fee architecture on overdraft protection because it is layered in a way most customers do not understand. At most major banks, overdraft protection is a product you opt into, but many accounts have it pre-enabled or customers were enrolled during account opening without fully understanding the fee structure. The monthly fee for having overdraft protection available, regardless of whether you use it, is typically $5 per month at most banks. That is $60 per year for a service you may never use but are being charged to have access to. When you actually use the overdraft, when your account goes negative, you pay interest on the negative balance. Overdraft interest rates at Canadian banks range from 19% to 22% annually, comparable to credit card interest rates. On a $200 overdraft carried for 15 days, the interest charge is small but real. On a larger or more persistent overdraft, it accumulates meaningfully. Then there is the NSF fee structure for transactions that exceed the overdraft limit, or for accounts without protection. At $45 to $48 per occurrence, a single NSF event costs more than 3 months of monthly account fees. 2 NSF events in a month, a check and a pre-authorized payment both bouncing on the same day, is nearly $100 in fees in a single morning. What the bank does not tell you: there are alternatives to the bank's overdraft product that are significantly cheaper. A linked line of credit, even a personal line of credit at prime plus 2 or 3%, used as an overdraft backstop costs a fraction of what overdraft protection charges. A credit card with a small available balance functions as an emergency payment mechanism without the monthly protection fee or the 21% overdraft interest rate. If you have overdraft protection on your account and you have never used it, call your bank and ask them to remove it. Eliminate the $60 annual fee for a service you are not using. If you have used it occasionally, model whether a linked line of credit would cost less over the same period. In almost every case it would. The paper statement fee. Every major Canadian bank charges between $2 and $2.50 per month for mailed paper statements. That is $24 to $30 per year for paper you may not have requested and may not even be opening when it arrives. If you went paperless at any point and were not explicitly confirmed as paperless in the bank system, You may have been paying for paper statements you are not receiving. Log into your online banking. Navigate to Statement Preferences, confirm you are enrolled in e-statements, and call the bank to request a retroactive credit for any paper statement fees charged after your paperless enrollment. Banks will often credit 12 months without a fight, the inactive account fee. If you have a savings account, a secondary checking account, or any account that has not had a transaction in a defined period, typically 6 to 12 months depending on the bank, you may be paying an inactivity fee of $10 to $20 per quarter. This fee is applied to dormant accounts automatically. Many Canadians who open secondary accounts for a specific purpose, a vacation fund, an emergency account they decided not to maintain, have forgotten these accounts exist and are being charged quarterly to not use them. Pull up the full list of accounts linked to your banking profile. Close any account you are not actively using and do not intend to use. The Safe Deposit Box Fee. Safe deposit boxes at Canadian bank branches cost between $60 and $200 per year, depending on size. This is a fee that many customers set up once and then forget, continuing to pay annually for a box that may contain documents they have not accessed in years or that could be stored digitally at no cost. The Certified Check Fee. Issuing a certified check at a Canadian bank costs between $10 and $20 per check. This fee surprises customers who assumed that basic banking instruments were included in their monthly account fee. They are not. If you regularly need certified checks for real estate deposits, legal transactions, or landlord requirements, model whether your account tier includes any certified check allowances and whether switching reduces this cost. The Foreign Transaction Fee. When you use your Canadian debit card to make a purchase in a foreign currency, or when you make an online purchase billed in US dollars. Most Canadian banks charge a foreign transaction fee of 2.5 to 3% of the transaction amount, in addition to whatever exchange rate margin they apply. On a $200 online purchase, the foreign transaction fee alone is approximately $6 to $8. For frequent travelers or online shoppers who regularly purchase from US retailers, this fee accumulates significantly. Several Canadian cards and accounts offer reduced or eliminated foreign transaction fees. This section is not about a fee. It is about the other side of the fee equation, what your bank is paying you for the privilege of holding your money, because the gap between what Canadian banks pay depositors and what they could pay is itself a form of hidden cost. The standard savings account interest rate at the Big Six as of 2025 is between 0.01% and 1.5% annually, depending on the account and any promotional rate in effect. On a $10,000 savings balance at 0.5%, you earn $50 per year. The Bank of Canada overnight rate, the base rate at which Canadian financial institutions lend to each other, has been significantly higher than that for much of the past 3 years. Banks borrow cheaply from depositors and lend expensively to mortgage holders and credit card borrowers. The spread between what they pay you and what they charge borrowers is their margin. Compressing what they pay you widens that margin. High-interest savings accounts at online institutions, EQ Bank, Oaken Financial, and others, consistently offer rates between 3% and 4.5% on standard savings deposits. No promotional period. No minimum balance above a nominal threshold. No monthly fee. CDIC insured on $10,000 in savings. The difference between 0.5% at a Big Six bank and 4% at an online institution is $350 per year. On $30,000, a reasonable emergency fund for many Canadian households, the difference is over $1,000 annually. That $1,000 difference is not a fee that appears on your statement, but it is money leaving your household and staying in the bank's margin, functionally identical to a fee in its impact on your financial position. Move your savings. Keep your day-to-day banking wherever is most convenient, but park your savings balance, your emergency fund, your short-term savings, any cash you are not actively spending, in an account that pays you a competitive rate. The transfer takes 20 minutes. The annual benefit compounds indefinitely. The Canadian banking system is not going to reform itself. The Big Six are not going to call you and suggest you switch to a cheaper account. The fee architecture exists because it works, because most customers do not read their statements carefully, do not know what alternatives exist, and do not act even when they discover they are overpaying. Here is exactly what you do starting tonight. Pull your last 12 months of bank statements. Go through every line. Write down every fee. Categorize them: monthly fees, transaction fees, e-transfer fees, overdraft fees, paper statement fees, NSF fees, anything else. Add them up. Get the annual number. Most Canadians who do this exercise for the first time are surprised by how large it is. Call your bank and ask 3 specific questions. First, what is the minimum daily balance required to waive my monthly account fee? And did my account qualify for that waiver in any months in the past year? Second, does my account include unlimited transactions and unlimited e-transfers? And if not, what would it cost to upgrade to a tier that does? Third, am I currently enrolled in e-statements? And have there been any paper statement fees on my account in the past 12 months? Request credits for any fees you should not have paid. Paper statement fees after going paperless. Monthly fees on months where your balance exceeded the waiver threshold. Banks will not always agree, but they regularly issue goodwill credits to customers who ask specifically and persistently. Get the representative's name. Escalate if the first representative refuses. Open a no-fee checking account comparison. Go to the Simply I Financial website, the Tangerine website, and the EQ Bank website tonight. Look at their account features: monthly fee, transaction limits, e-transfer policy, overdraft options. Compare to what you are currently paying. If the no-fee option covers your usage requirements, the switching cost is a single afternoon. Most Canadians spend that afternoon once and never pay a monthly bank fee again. Move your savings balance. Open an EQ Bank or Oaken Financial savings account. Transfer your emergency fund and any cash savings you are not actively using. Do the math on the annual interest difference. It will not feel abstract when you see it as a dollar figure. Close accounts you are not using. Log into your full banking profile. If there are accounts with balances near zero that you have not used in the past year, close them. Eliminate any potential inactivity fees. Withdraw any remaining balance first. Review your overdraft setup. If you have overdraft protection and have never used it, ask to have it removed. If you have used it regularly, price out a personal line of credit as a cheaper alternative backstop. The fees are not going to stop appearing on your statement because you watched a video. They stop when you change your account structure, move your savings, and stop letting the bank assume you are not paying attention. The woman in Calgary got $60 back from her bank. She spent the following weekend going through her full banking setup. She switched her savings to EQ Bank. $28,000 that had been sitting at 0.5% is now earning 3.75%. She upgraded her checking account to an unlimited tier and eliminated $22 per month in transaction overages. She discovered and closed a dormant savings account that had been charging her a $10 quarterly inactivity fee for 3 years. Her total annual banking cost went from $438 in fees and $140 in earned interest to $0 in fees and $1,050 in earned interest. The swing is over $1,300 per year. From one weekend of attention and 4 phone calls, the bank knew her account structure the entire time. The bank had her balance data. The bank could see the transaction overages, the dormant account, the savings sitting at 0.5%. The bank said nothing. They were counting on her not looking. She looked. So did you.